Hi everyone. Now you probably wouldn't need any introduction, and I just wanted to tell about how I'm solving the problem of impermanent loss, which I decided to spin up as a separate project. And at the same time, I would mention a few changes to curve crypto pools, which apart from yield basis will also power swaps of currencies like euro and dollar, for example, like foreign exchange swaps, or also probably swaps of assets like gold, for example. Apparently the same changes in crypto pools which I needed to in a yield basis are also needed for these sorts of applications. So let me switch to the slides. All right, and maybe some people saw them already, and maybe it was even in the context of Bitcoin, but actually it's not about Bitcoin, it's about solving the problem of impermanent loss. So what is impermanent loss? Why is it such a big deal? Imagine that you put crypto liquidity in volatile coins in some, let's say, simplest Uniswap2 pool, for example. This or maybe in curve crypto pools, because they have the same impermanent loss, although they are slightly different. If you do that, then your portfolio will be always rebalanced. So let's say you put Ethereum and USDC in a liquidity pool. If your Ether goes up, then obviously the pool starts selling this Ether to some external traders, and value starts a little bit deviating from the value of Ethers and stablecoins, which are doing nothing. And it appears that value in the pool, so if you deposited here, and if the price went up, it appears that value in the pool would actually be smaller than value of your portfolio of the same coins doing nothing. So imagine that you have, over here you have 50-50, I don't know, ETH USD, right? And well, if it is still ETH and USD, you have the same number of ETH and same number of USD along this straight line. But if you put in liquidity pool, you actually have less value. Now imagine that the price of ETH actually went down, not up. So you moved along this line while you are in liquidity pool and got in here. And again, it appears that assets which are doing nothing, they are worth more than your liquidity in liquidity pool. So maybe this all black line is going up because you earn fees while you're in AMM, right? And some people might hope that this movement up will cover this gap, but usually it doesn't. For example, over several years, you may get APR in, let's say, ETH USD pools like several percent, or in WBTC to USD pool, and maybe Bitcoin went up by factor of 5, but you earned maybe only a few percent and lost quite a bit more over here. This is why a provision of crypto liquidity is not very popular, and that's why crypto, like volatile crypto liquidity, is dominated by market-making firms, not really by passive liquidity providers in DeFi. While in stablecoins, actually DeFi is probably holding the most the most of liquidity density. Anyway, is it possible to solve this problem? And actually, the answer is yes. So let me explain how. Imagine that you have crypto, let's say BTC, like wrapped Bitcoin and USD stablecoin. So if you put your liquidity in liquidity pool, this price of your LP token is apparently proportional to square root of crypto price, right? So it's if you look back at this graph, the solid line looks awfully similar to square root, and it actually is. Of course, you get it multiplied by whatever factor, which means that you're earning fees, but it is still square root fundamentally. And this is what is causing us troubles. So we want to really get rid of this square root somehow. How do we do it? Apparently, it is possible to construct a position which actually squares this square root, so it disappears. So what this position would be? Apparently, it is compounding leverage. Well, it's a little bit different from normal leverage. So in normal leverage, you borrow against some asset and keep the loan size constant. So you get the growth, but you kind of get less capital than you bring less capital than your collateral is. Here we would always change the loan size. So imagine you create this position. You bring some BTC USD liquidity, right? You take a loan which is of a size equal to what you brought, and borrow kind of the same amount of BTC USD liquidity, so that BTC USD liquidity size is 2 times bigger than the loan. So let's say, well, this size is 2x, this value is 2x of the loan size, right? And if it so happens that Bitcoin price goes a little bit up, then maybe value of your collateral goes up, right? And if that happens, then this loan is not 50% of the value of your collateral anymore. So what we do, we borrow more, take, let's say, a piece, this piece which we borrowed, and buy even more, even more collateral. So the ratio again stays 50%. So the new loan size, this one is 50% of this new collateral size. If you do that, then this overall position squares, well, is price of value of that is proportional to square of the value of your collateral. But remember, value of your collateral was square root of Bitcoin price. So you square the square root, and the value of your resultant position will be proportional to Bitcoin price, plus it would earn some of the exchange fees. So that's the kind of overall idea. But apparently, just this idea is not enough. So if you apply this method to actual Uniswap 2 pools, it doesn't quite work. So of course, when you leverage by factor of 2, that's nice because you earn twice as much fees. You of course pay the borrow rates, but let's forget about these for a second. And most importantly, you have this loss rate. This loss rate is associated with us changing the loan size and buying more collateral or selling some collateral to repay some of the loan all the time. When we do that, we actually experience some losses, or maybe it's good to call it volatility decay, because the higher the volatility is, the higher this loss is. And if we actually apply this method to Uniswap 2, to xy equals k AMM, then it appears that what we lose over here is apparently equal to what we earn over here. So Uniswap 2 actually wouldn't earn money if we get rid of impermanent loss somehow. It's not like it doesn't have to be this way, but I mean that's what simulations show, which is interesting but not very useful because we actually want to make money on providing liquidity. We don't want to probably to work for free. Well, as you probably know, I'm a Curve founder, and we are using Curve AMMs. So how would it work with Curve AMMs? Curve AMMs actually do have concentrated liquidity, but this liquidity is automatically managed, and impermanent loss of Curve AMM is similar to impermanent loss of Uniswap too. So let me explain how Curve AMM, Curve crypto pools work. Many of you probably know that Curve crypto pools exist since 2021, right? So they exist since then. And they do have concentrated liquidity, although it's usually not very concentrated. How they work? Imagine liquidity is concentrated around certain price. And if the current price is, I don't know, somewhere here, right? So it's fluctuating around these values. Everything is great because liquidity is dense. We are earning good fees. Slippages are low. APR is high. Everything is good. But if it so happens that the current price changes and you appear to be somewhere at the edge of the concentrated liquidity, then everything is not so great because you suddenly your liquidity is much less concentrated and you earn fees way slower. So what should we do? Well, it's very tempting to move the whole concentrated liquidity to the new place, right? But movement of concentrated liquidity is always associated with the loss. And this is actually inevitable. You probably saw that with liquidity managers on Uniswap 3, which kind of rebalanced all the time. And for them, it was very hard to actually make money. And here it's not an exception. So moving concentrated liquidity means a loss. What we do at Curve, right? We keep some sort of budget for these movements. And if we have some funds in the budget to move concentrated liquidity, then we actually do it, right? But if there is no budget to move concentrated liquidity, then the smart contract decides to not move it, and it stays where it was, or moves just a little bit if there is a little bit of a budget, and waits until pool makes more money to move this concentrated liquidity. So where do the money to move concentrated liquidity come from? And yeah, that's probably the key here, right? As of today, and since 2021, the money to move concentrated liquidity comes from fees which the pool is making. So 50% of fees is going to liquidity providers and admin fees and so on, but another 50% of fees charged, they go to refill this rebalancing budget, right? So, and that's what's happening today. And this is great, but it has one issue. And the issue is this. Let's go back here. Imagine that you are sitting somewhere here on the edge of concentrated liquidity, and there is no budget to move it. You are earning money with a smaller rate because your liquidity is not concentrated, right? And you need to move all this heavy beast to the new place. But you need to earn a lot of money to do it, and you are not earning money fast, so you need to wait like forever to do it. And to actually not have it happening, what we're doing currently is making liquidity not that concentrated. So the concentration is actually smaller than it could have been, exactly because well, if you make it smaller here, then it's not as heavy, so not too hard to move this concentrated liquidity, so you can actually make money here on the edge. And at the same time, if you make it not as concentrated here, probably its concentration is a little bit higher here. But then it's closer to XYK really. Anyway, today this concentration is maybe, I don't know, maybe 3-5x, but not really more, because it becomes too heavy to move. So, well, we probably should do something to make it easier to move when we are so far off peg. And it appears that there is one way. So one way is this. Now we have Curve USD. Curve USD is a CDP stablecoin. So why don't we pair our crypto with Curve USD? And well, when Curve USD exists, it's somebody's paying, somebody's borrowing it, so somebody's paying interest rate. So why don't we spend this exact interest rate to support dense liquidity, to refill this budget, with the hope to actually get more here than we spend here. But that's that's how we can make markets with actually not Bitcoin, but with euro, with gold, and so on. Over there, this method appears to be very, very efficient. But here, when we are removing impermanent loss, we actually we ourselves as liquidity providers, we are paying interest rate. So if we go back to this scheme, we have this loan, and with this loan we are paying some interest rate, so it should go somewhere. Of course, it could go to curve system or to yield basis system or whatever, but why wouldn't it go to why wouldn't that rate which we ourselves as liquidity providers pay, why wouldn't it go to be invested into efficiency of the pool, which will make fees for us? So we have some negative APR, which is like borrow rate essentially, paid towards this pool, which makes us fees, and it becomes more efficient, maybe earns more fees, and maybe we get more fees than we invested. Is it true? Let's find out. To do that, I did essentially some simulations, right? Well, the way I'm doing simulations is this. I'm only simulating arbitrage between liquidity pools and some external venue, some external price source. Binance or Curve, well, it appears that Curve prices are actually the best, surprisingly, but Binance prices also can be to, well, if you remove squeezes, they also give the same result, and surprisingly, these results also correspond to what pools, how real pools work. So they actually match reality, which is nice. So if you take data from, I think it was from beginning of 2023 till about end of October 2024, right? And for this data, in XYK bonding curve, in Uniswap 2, you would have earned 3%, right? If you configured a curve pool between wrapped BTC and USD stablecoin, and maximized APR there, then it would be about 5.5% APR, well, before admin fee, of course. And if we spend about 5% rate on like this as an investment in our rebalancing budget, then the pool makes 13%. So actually, you see the difference here is actually plus 7.5%. So we spend minus 5%, right? Because it was the borrow rate, but we've got plus 7.5%. So we are net positive here, which is great. And so the method works. And well, this is just curve pool at the moment. It's curve pool, which is still having impermanent loss. So what happens if we get rid of this impermanent loss? And to do that, well, instead of using this formula is just to understand what the loss consists of, but to actually calculate it precisely, I model this re-leverage process. I'm actually doing it not manually. I developed a special AMM which keeps the leverage constant, so it makes compounding leverage of everything you put in there, and I'm putting their liquidity of curve pools. So it appears that if you applied to the range which I just mentioned, so 2023 till end of October 2024. The APR here is around 10%, right? Well, actually 9% average APR over kind of bearish part of the market, although which had some interesting Bitcoin events. But if you apply it over 6 years, so since 2019 till again end of 2024, then the APR, average APR here is 20%. Most of that is happening in year 2021, where volatility of Bitcoin was very, very high, and actually it makes money on volatility, so it would have earned quite a bit over there, but well, our last 2 years are actually here, right? So this part is actually this one. So anyway, it appears that APRs are fairly decent, and simulations match reality, so like real existing pools. So I thought, why not make it like removal of impermanent loss live? And currently it's finished its development. Yeah, these are just some numbers which of what simulations showed. 2021 was crazy. Don't expect that to be repeated. I think now it's not as volatile, but yeah. So yeah, just to summarize, there is this update to crypto pools incoming, which is useful for multiple for multiple use cases, like markets like euro dollar or gold dollar or maybe other national currencies. But the same way is very well suitable for removing impermanent loss, which is done the way I just described. Thank you.